Okay, let's unpack this. Welcome to the deep dive. We're here to cut through the noise and get straight to what matters. Today, we're plunging into, well, the often pretty complex world of partnership tax rules. We're talking formation, how money flows, and crucially, what it all means for you, the partner, and your financial picture.
Exactly. That's our mission today. We're taking some, frankly, dense material on partnership tax, and we're going to distill it down into clear, actionable understanding. The goal isn't just knowing what happens with these rules, but really why they exist and, how they can seriously impact your business strategy. We'll try to simplify every detail, make it genuinely easy to grasp.
Okay, great. So let's start right at the beginning. Forming a partnership and the tax side of things. What exactly is a partnership in the eyes of the tax code? Usually we're talking about a flow-through entity, right?
That's the core concept, a flow-through entity. Think of it like this. The business itself, it doesn't pay income tax. Instead, the profits or losses, they flow through directly to you, the partner. Then it's taxed just once on your personal return.
Which avoids that whole double taxation issue you see with C Corp.
Precisely. It's a big advantage. And this applies to general partnerships, limited partnerships, even LLCs, limited liability companies. They're usually treated like partnerships for tax purposes.
Okay. And how do partners get their ownership? Is it always cash?
Not always, no.
Okay.
Partners typically get their interest by putting in cash, sure, but also by contributing property, land, equipment, buildings, or even through contributing services, their time or expertise.
Right. Now, there's a fundamental rule here, isn't there, about contributing property, something designed to help businesses start up.
Absolutely. It's a key rule. Generally, when you contribute property to a partnership for an interest, you don't recognize any immediate gain or loss.
And why is that so important?
Well, it's huge for getting ventures off the ground. It means you can pool assets with others without triggering an immediate tax bill just for putting your property into the pot. So, say you contribute land. You bought it for $30,000, now it's worth $50,000. Normally, that $20,000 increase would be a gain, but here, no tax at the moment of contribution. It's deferred.
Deferred, okay. That makes sense. A big help.
Definitely. And speaking of interest, we need to distinguish two main types. First, there's a capital interest.
Capital interest, what's that?
It gives you a right to a share of the partnership's net assets if it were to liquidate, like right now. Your slice of the current pie.
Okay. And the other type?
That's a profits interest. This is different. It's just the right to share in future profits or losses, not necessarily the existing assets.
Ah, okay. Future profits versus current assets. And this distinction gets really interesting with services, right?
Exactly. Here's where it matters a lot. If you get a profits interest for your services, you generally do not recognize immediate ordinary income.
Why not, if you're getting something of value?
Because it's tied to uncertain future profits. At the moment you receive it, it often has no real liquidation value. If the partnership cashed out right then, that profits interest might be worth nothing. It's speculative.
Yeah.
So the IRS generally waits until actual profits come in. So getting a 20% profits interest for your consulting work, usually no immediate tax hit.
Okay, that makes sense. But what about the other type? A capital interest for services.
Completely different story there. Receiving a capital interest for services is a taxable event right away.
Taxable, how much?
The compensation is considered the liquidation value of that capital interest when you get it. That value goes right onto your tax return as ordinary income. The partnership, on its side, might deduct or capitalize that amount, depending. So if you get a 20% capital interest in a partnership with, say, $80,000 in assets, you'd recognize $16,000 as ordinary income, like you earned it and invested it back in.
Wow, okay, big difference there. And you mentioned another exception earlier about contributing property with debt.
Right. There's one more key exception to that no gain on contribution rule. If you contribute property that has a liability attached, a mortgage, and the amount of that liability that the other partners effectively take on exceeds your basis in the property, that excess amount is treated as taxable boot.
Taxable boot, like extra cash.
Sort of. It's like you receive debt relief beyond your investment cost.
Yeah.
The IRS sees that as a gain you need to recognize now at the time of contribution.
Got it. Okay, that covers formation and exceptions. Let's shift gears. Let's talk basis. Foundational concept. Right?
Absolutely critical. We're
All
talking
right.
outside basis. Think of it as your tax cost in your partnership interest, your financial footprint in the partnership.
Like a scorecard tracking your investment.
Exactly. It tracks your investment, your share of profits, debt, everything. So how do you calculate your initial outside basis? You start with any cash you put in. Add the adjusted basis of any property you contributed. If you got a capital interest for services, add the fair market value of those services. Then, and this is crucial, you subtract liabilities on the property you transferred, but only the portion assumed by the other partners.
Ah, only the part the others take on. Makes sense. You're relieved of that debt.
Correct. And finally, you add your share of the partnership's overall liabilities. That pass key about subtracting only the debt others assume is vital. It trips people up.
Okay. And that last part, adding your share of partnership debt, that seems like a really big deal for basis.
It is. How debt impacts your basis is huge, and it depends on the type of debt and the type of owner you are.
Okay, break that down for us.
First, recourse debts. These carry personal liability. If the partnership defaults, creditors can come after the partners personally. So these debts, they're allocated only to partners who have that personal liability, typically general partners or maybe LLC members or limited partners who personally guarantee the debt.
Okay, so risk equals basis boost for those specific partners. What about the other kind?
Non-recourse debts. These are usually secured by specific property, like a building mortgage. The lender can only go after that property, not the partner's personal assets. No personal liability. So these are allocated to all partners or members, usually based on their profit-sharing ratio.
Can we walk through an example, maybe that AB partnership you mentioned?
Sure, let's say AV partnership, 50-50 profit sharing.
Yeah.
A is a general partner, B is a limited partner. They take out a $100,000 recourse loan. Who gets the basis increase?
Only A, the general partner, because she's personally liable.
Exactly. A's basis goes up by $100,000. B gets zero from that debt. Now, what if that same $100,000 loan was non-recourse?
Then it's split based on profit
Yeah.
ratio, so $50,000 each.
You got it. Both A and B increase their bases by $50,000. It all comes down to who bears the economic risk.
Makes sense. What if a partner loans money to the partnership?
Good question. That's treated as recourse debt, but it only increases the basis of the lending partner. They're putting more at risk.
Another key rule for basis. It can't start negative. Right.
That's right. A fundamental principle. Your initial basis cannot be negative if the liabilities you transfer do exceed the basis of the property you put in. Remember that taxable boot. You recognize gain on the excess. Your initial basis then becomes zero, but you paid tax on that gain already.
Got it. Zero basis, but tax paid. What about holding period? Does that carry over?
It often does. If you contribute a capital asset or certain business property, the partnership's holding period usually includes the time you held it. But if you contribute something like inventory, the holding period for the partnership interest starts fresh.
And basis isn't static, right? It changes over time.
Constantly. It's adjusted upwards for things like additional contributions, your share of income and gains, and increases in partnership debt. And it decreases with distributions you receive, your share of losses and deductions, and decreases in partnership debt. It's always moving.
Always reflecting your current stake.
Precisely.
Yeah.
Now, another important adjustment relates to special allocation, built-in gain or loss.
Built-in gain or loss. What's that about?
This is about fairness. When a partner contributes property where the market value is different from its tax basis, any gain or loss that already existed on that property before contribution, the built-in part, must be allocated back specifically to that contributing partner when the partnership eventually sells the asset.
Ah, so the person who brought the appreciation or depreciation gets taxed on it.
Exactly. But any new gain or loss that happens after the contribution, that's shared among all partners according to the regular profit ratios. Let's use Joan's example. She contributes land. Basis $100K, market value $150K, that's a $50 built-in gain. Later, the partnership sells it for $180K.
Okay, so total gain is $80K.
Right. But that first $50, the built-in gain, that goes solely to Joan. The remaining $30K of gain, the post-contribution part, is then shared by all partners based on their percentages.
That makes perfect sense. Prevents shifting pre-contribution gains. We've talked a lot about outside basis. What's inside basis?
Good distinction. Inside basis is the partnership's basis in its own assets. Outside basis is your basis in your interest. Inside basis, the partnership's basis in its property. Generally, when property is contributed, the partnership takes a carryover basis.
Meaning its basis is the same as the contributing partner's basis was.
Correct. Let's use Jeff's example to tie this together. Year one. Jeff puts in $10K cash and a building, basis $100K, FMV $300K subject to $90K liability, for a 13 interest in KNC. His initial outside basis. It's $10K cash plus $100K building basis, $60 liability assumed by others, 23 of $90K, so $50,000.
Okay, $50K outside basis for Jeff. What's KNC's inside basis in the building?
That's the carryover basis, $100,000. And the holding period tax on Jeff's time. Now, year 2, Jeff has another building, base is $300, and KNC earns $150K income. Jeff's outside basis at the end of year 2. It's the initial $50K plus $300K for the new building, plus his $50 share, $13 of income, total $400,000.
And the inside basis for the new building is $300 K carryover.
Exactly. See how it all connects and adjusts?
Yes, that example really clarifies the mechanics. So one last recap on carry-in basis versus capital account.
Crucial point. Your capital account is like your direct equity stake contributions plus earnings minus distributions. Your basis is your capital account plus your share of partnership liabilities. That basis number is key because it limits your deductible losses and affects how distributions are taxed. Big difference.
Okay, let's talk about those losses. What hurdles does a partner face to actually deduct a loss?
There are 4 main hurdles, similar to S-Corp. First, the tax basis limitation. Second, the at-risk limitation. Third, passive activity loss, PAL rules. And fourth, the excess business loss limitation. It's important to note, tax basis and at-risk are applied first, often at the partnership level, limiting the flow-through. PAL and excess business loss are then applied at your individual level.
Let's start with tax basis limitation. Sounds straightforward.
It mostly is. You can only deduct losses up to your tax basis in your partnership interest. Simple cap. If your share of loss is more than your basis, the excess is suspended. You carry it forward indefinitely, and you can use it later if your basis increases, maybe through income or more contributions.
But what happens if you sell your interest with suspended losses?
This is critical for tax basis suspended losses. They are lost forever if you dispose of your interest before using them. Poof, gone. The logic is you no longer have basis, no skin in the game, so no deduction. So your basis is $3, loss is $4. You deduct $3 now, suspend dollars, sell your interest next week. That $1 vanishes.
Ouch. Okay, what's the next hurdle? At-risk limitation.
Right, the at-risk limitation. It's similar to tax basis, but focuses more on your economic risk. The key difference involves non-recourse debt. Your at-risk amount includes your cash, property basis, and your share of recourse debt. It also includes a specific type of non-recourse debt called qualified non-recourse financing, or QNF.
QNF, what qualifies?
Think standard commercial real estate loans from unrelated lenders, like banks. Arm's-length financing. What's not included in your at-risk amount is other non-recourse debt stuff that isn't QNF, even though it is included in your tax basis.
So tax basis can be higher than at-risk basis because of that non-QNF debt.
Exactly. Losses suspended due to the at-risk rules are also carried forward indefinitely. But unlike tax basis suspended losses, these can be used to offset gain when you eventually dispose of your interest.
Okay, slightly better treatment there. Can we use that ABC partnership example again to see how debt affects both?
Sure. ABC partnership, equal partners. A and B are general, C is limited. They have $60K QNF debt, $30K other non-recourse, and $20K recourse debt. The $20K recourse only boosts Amy's tax basis and at-risk basis by $10 each. C gets 0.
Because C isn't personally liable.
Right. Now, the $60 QNF and $30 other non-recourse, for tax basis, all 3 partners get 13 of both. So $20 from QNF plus $10K from other non-recourse, that's $30K each added to tax basis. But for at-risk basis, only the QNF counts. So each partner only adds $20K from the QNF to their at-risk amount. The other non-recourse doesn't count here.
So A and B added $10K recourse plus $30K non-recourse equals $40K to tax basis, but only $10K recourse plus $20K QNF equals $30K to at-risk basis, and C added $30K non-recourse to tax basis, but only $20K QNF to at-risk basis.
You got it. It shows how the debt types create different results for the 2 limitations.
Can you quickly summarize how the different suspended losses are treated again?
Sure. Tax basis suspended loss. Carry forward lost on disposal. At-risk suspended loss. Carry forward can offset gain on disposal. Passive activity loss. PAL. Carry forward against passive income, or fully deductible on disposal of activity. Excess business loss. Carry forward as a net operating loss. NOL. Subject to limits.
Okay, great summary. Let's try a full example putting these first 2 limits together. Rachel's LLC.
Okay, Rachel forms an LLC, taxed as partnership, contributes $20K cash, her share of debt, $5K recourse she guaranteed, $8K non-recourse but not QNF. First year loss allocated to her, $35,000.
All right, first step, calculate her tax basis.
Tax basis $20K cash plus $5K recourse plus $8K non-recourse equals $33,000.
Okay. Next, her at-risk amount.
At-risk amount, 8 pay to cash plus 5K pay recourse equals $25,000. Remember, the non-QNF non-recourse is excluded here.
Right, so she has a $35,000 loss. How much can she deduct? Apply the limits sequentially.
Exactly. First, the tax basis limit. Her basis is $33,000. The loss is $35,000. So she can only potentially use $33,000 of the loss. The other $2,000 is suspended due to insufficient tax basis.
Okay, $2 suspended right off the bat. Now take the remaining 33K loss to the at-risk hurdle.
Her at-risk amount is $25,000. So of that $33,000 loss that passed the tax basis test, only $25,000 gets past the at-risk test. That means another $8,000, 33K, 25K, is suspended due to the at-risk limitation.
So in the end, Rachel can only deduct $25,000 this year.
Correct. She has $2,000 suspended due to tax basis rules and $8,000 suspended due to at-risk rules. Both carry forward.
That really shows how you have to clear each hurdle. Okay, shifting gears slightly, tax elections, who makes those?
Mostly the partnership itself. Things like accounting methods, depreciation, tax year. The partnership usually decides for everyone.
Makes sense, keep it unified. Now, what about transactions between a partner and the partnership? Like if a partner sells something to the partnership?
Generally, if the partner isn't acting as a partner, like they're just providing a specific service or selling property, it's treated like a transaction with an unrelated party.
But there must be limits, right? To prevent games?
Absolutely. Key limitations involve related parties. Specifically, controlling partners, usually meaning over 50% interest. Related party loss. If a controlling partner sells property to the partnership at a loss, that loss is disallowed. Can't create artificial losses. Related party gain. If a controlling partner sells property to the partnership and it's not a capital asset for the partnership, like inventory, any gain on that sale is treated as ordinary income, not capital gain. Prevents converting income types.
Okay, anti-abuse rules for controlling partners. What about guaranteed payments?
Guaranteed payments. These are payments to a partner for services or the use of capital that are calculated without regard to the partnership's income, like a salary. Even if the partnership has a loss, the payment is made.
And how are they taxed?
They have dual treatment. They are deductible by the partnership, reducing its income, and they are ordinary income to the partner who receives them. This income usually counts for self-employment tax too, but importantly, it's not qualified business income, QBI, for that Section 199E deduction.
Okay, let's use the James example. 50% general partner gets $20 K guaranteed payment. Partnership had $100 K income before the payment.
Right, so the partnership deducts the $20. Its ordinary income becomes $80,000. James's share of that is 50%, so $40,000. Plus, he receives the $20,000 guaranteed payment directly. So James recognizes a total of $60,000 income from the partnership, 40K share plus 20K payment.
Got it. And a quick note on retirement payments.
If they aren't part of liquidating the partner's entire interest, they're generally ordinary income to the recipient and deductible by the partnership.
Okay, last major area, non-liquidating distributions. Getting assets out while the partnership continues, taxable.
Generally non-taxable, both to the partner and the partnership. These are also called current or operating distributions. The basic rule is simple. Distributions reduce your outside basis. Cash first, then property.
Okay, reduces basis. What about the basis of the property received?
For property distribution, your basis in the asset you receive is usually the partnership's inside basis in that asset. Carryover basis again. However, there's a key limit. If your outside basis, after any cash distribution, is less than the property's inside basis, your basis in the distributed property gets reduced down to match your remaining outside basis. This prevents your outside basis from going below zero. The property basis takes the hit.
Okay. Basis reduction on the property to protect the partner's outside basis. But what about cash distribution? You can't reduce the basis of cash.
Exactly. That's the crucial difference. If you receive cash that's more than your outside basis, you must recognize a capital gain for the excess amount. Since cash basis can't be reduced, gain recognition is the only way to stop your outside basis from becoming negative.
Let's use Olinto's example. Basis $30 Ks. Gets $24K cash and land with partnership basis of $9 K.
Okay, first, reduce outside basis by the cash. 30K, 24K equals 6 killers remaining outside basis. Now, the land distribution. The partnership's basis is $9, but Olinto only has 6 killers outside basis left. So his basis in the land is limited to 6,000K. The land's basis is reduced. His outside basis then goes to 0. 6K, $6 case. No gain recognized here because the property basis absorbed the limitation.
Perfect. Now, what if multiple assets are distributed and the total basis exceeds the partner's outside basis? Is there an order?
Yes, a specific order is crucial, especially regarding hot assets. When your remaining outside basis isn't enough to cover the inside basis of all distributed assets, you allocate your remaining outside basis in this order. First to cash, which we already handled by reducing basis or recognizing gain. Second to hot assets, things like inventory and unrealized receivables. These generate ordinary income. Third, whatever basis is left goes to any other property distributed, like land or equipment.
Why allocate to hot assets before other property?
to preserve their ordinary income character. It prevents partners from potentially converting ordinary income into capital gain by manipulating which assets get basis.
Okay, let's use Alinto again. Basis 30K. Distribution, 24K cash. Inventory, hot asset, basis $5. Land, basis $9. Total inside basis is 38K, more than his $30 outside basis.
Right. Step 1, reduce outside basis by cash, 30K, 24K, and so 6K remaining basis. Step 2, allocate to hot assets. The inventory has a $5K basis. Alinto has 6K basis left. So the inventory gets a basis of $5K in Alinto's hands. His remaining outside basis is now 6K. 5K equals $1,000. Step 3, allocate remaining basis to other property. The land has a $9 inside basis, but Alinto only has a $1,000 basis left. So the land's basis in Alinto's hands is reduced to $1,000. His final outside basis is 0. His basis in assets received, 24K cash, 5K inventory, 10K land. Total $30K, matching his original outside basis.
That step-by-step allocation makes it clear. Wow, okay. We have really covered a ton today. From, the nitty-gritty of forming partnerships and calculating basis, all the way through loss limits and distributions. It's definitely complex, but knowing these details really feels empowering.
It absolutely is. Understanding these, more advanced topics isn't just about filing taxes correctly, though that's important. It's truly about making informed strategic decisions for your business, knowing how contributions, different debt types, distributions,
Yeah.
how they all impact your basis and tax bill. That can fundamentally shape your financial strategy. It's powerful knowledge.
So the question for you listening is, what does this all mean for your situation as you look at your own business ventures or maybe future ones? How might understanding these, let's face it, sophisticated partnership rules change how you think, how you approach equity, debt, structuring deals, planning for profitability? Definitely something to mull over until our next deep dive.